Welcome back to the channel. Today we're going to tackle a question that a lot of people are starting to ask quietly, even if they're not saying it out loud yet. Could XRP be one of the best investments to make going into 2026? Not next week, not tomorrow, not off a headline pump, but as a strategic position looking a full cycle ahead. And before anyone jumps to conclusions, this isn't about hype, moon targets, or fantasy numbers. This is about whether XRP, based on where it stands right now, is structurally positioned better than most people realize. XRP is one of the most misunderstood assets in crypto. For years, it wasn't even evaluated on fundamentals. It was evaluated through noise, lawsuits, misinformation, tribalism, and endless comparisons that missed the point entirely. A lot of people wrote it off, not because they studied it, but because it was easier to follow the crowd. That's important to acknowledge because markets have a habit of rewarding assets after the crowd has already dismissed them. What makes this moment different is that we're no longer talking about hypotheticals. One of the biggest clouds hanging over XRP for nearly half a decade is gone. The regulatory battle that defined XRP's narrative for years is now resolved. And whether people like Ripple or not, the reality is that regulatory clarity matters. Markets price uncertainty brutally. When that uncertainty is removed, the entire risk profile of an asset changes. For the first time in a long time, XRP can be evaluated like a real asset instead of a legal question mark. That alone doesn't make it a good investment, but it removes a massive reason why institutions, funds, and large allocators stayed on the sidelines. And that shift is subtle but powerful. Capital doesn't rush in overnight. It re-enters cautiously, structurally, and over time. Another thing people consistently underestimate is how institutions actually think. They don't care about crypto Twitter debates, they don't care about memes, they care about compliance, scale, liquidity, and whether an asset fits into existing financial rails without blowing up risk models. When you filter crypto through that lens, the list of viable assets shrinks dramatically. Outside of Bitcoin and Ethereum, there are very few networks that even qualify for that conversation. That's where XRP starts to stand out, not because it's perfect, but because it's been built with a specific role in mind from the beginning. Cross-border settlement, liquidity bridging, and integration with financial institutions aren't narratives that appeared last cycle. They've been part of XRP's design philosophy for years. The difference now is that the regulatory and institutional environment is finally catching up to that design. It's also important to be honest about timing. We're not talking about a market that's euphoric and chasing anything with a ticker. We're talking about a market that's been burned, cleaned out, and forced to mature. That kind of environment favors assets with durability over assets with hype. It favors infrastructure over speculation, and it favors projects that can survive scrutiny, not just attention. Looking ahead to 2026 specifically matters because that's far enough out to allow structural changes to actually matter. ETFs don't rewire markets in weeks. Institutional partnerships don't change liquidity overnight. Regulatory clarity doesn't instantly reprice everything. These are slow-moving forces, but when they compound, they matter far more than short-term price action. This is also where people make a critical mistake. They assume that if an asset hasn't already exploded, it must be dead. That's lazy thinking. Some of the best performing assets in any cycle are the ones that spent years being ignored while infrastructure was quietly built underneath them. By the time the narrative shifts, most of the upside is already in motion. None of this means XRP is guaranteed to succeed. There are real risks, there is real competition, and there are plenty of ways this thesis could take longer than people expect. But dismissing XRP outright in 2025 and 2026 without examining the facts is no longer an informed position. It's an emotional one. So in this video, we're not going to sell dreams. We're going to walk through the actual catalysts, the structural changes, and the reasons serious investors are starting to revisit XRP as a long-term position, not because someone said it's going to a ridiculous number, but because the environment around it has fundamentally changed. If you want to understand why the conversation around XRP has changed so dramatically, you have to start with regulation. Not headlines, not opinions, but actual resolution. For years, the SEC case wasn't just a lawsuit, it was a structural chokehold. It froze institutional interest, scared off custodians, blocked ETF conversations, and kept XRP in a legal gray zone that serious capital simply does not touch. Institutions don't speculate around unresolved regulatory risk. They wait. And that's exactly what happened here. When the Ripple SEC case officially reached its conclusion in August 2025, it didn't just close a chapter, it removed one of the largest overhangs any major crypto asset has ever faced. Ripple agreed to a defined settlement, both sides withdrew their appeals, and for the first time in years, XRP had legal clarity in the United States. That matters more than most people realize. Markets hate uncertainty, but they especially hate open-ended uncertainty. Once that risk was capped and quantified, XRP's profile changed overnight, even if the price didn't immediately reflect it. This is where retail often gets confused. People expect price to react instantly to good news. That's not how institutional markets work. When legal clarity arrives, it doesn't trigger hype buying, it unlocks processes. Custodians can list, funds can model exposure, banks can integrate, ETF issuers can file. None of that shows up as a green candle the next day, but all of it reshapes the long-term demand curve. And this leads directly into the ETF conversation, which is arguably one of the most misunderstood catalysts in crypto. XRP-related ETFs and basket products have already begun seeing significant inflows, but much of that activity has happened through OTC-style accumulation and long-term structures. That's why people keep asking the wrong question: why isn't the price pumping? Because this capital isn't chasing momentum, it's positioning for multi-year exposure. The Vanguard decision in December 2025 is a perfect example of this shift. Vanguard didn't just allow crypto, they reversed a long-standing policy and opened access to crypto ETFs, including XRP-focused products, for tens of millions of clients. That's not retail speculation, that's institutional distribution. And when distribution changes, markets change, even if it takes time to show up. Another important point here is how these ETFs operate. Unlike speculative trading products, many of these vehicles are designed for long-term holding, pension exposure, and portfolio diversification. They don't rotate in and out every week. They accumulate quietly, rebalance slowly, and reduce circulating supply without creating short-term volatility. That's why ETF inflows don't behave like hype-driven spot buying. This is also why dismissing ETFs because price hasn't moved yet is a mistake. ETFs don't exist to create pumps. They exist to normalize exposure. And once an asset becomes normalized inside traditional portfolios, its volatility profile, liquidity structure, and demand base all change over time. Regulatory clarity plus ETF accessibility is not a flashy catalyst. It's a foundational one. It doesn't promise instant upside, but it dramatically reduces downside risk relative to where XRP stood just a few years ago. And for long-term investors, risk reduction matters just as much as upside potential. This is the lens serious capital uses. Not how high can this go next month, but does this asset still exist, still matter, and still integrate 5 years from now? XRP has crossed a threshold that many projects never will. It survived regulatory scrutiny and came out with a clearer path forward. Now let's talk about adoption and supply, because this is where the XRP conversation shifts from theory into mechanics. Regulation clears the path, but adoption is what actually moves the needle over time. And what's happening here isn't loud, speculative adoption. It's quiet institutional positioning that most people overlook because it doesn't create instant price action. One of the clearest signals is how XRP is being integrated into real payment and settlement flows instead of being treated purely as a trading asset. The partnership involving MasterCard, WeBank, and Gemini is a perfect example. This isn't a press release designed to excite crypto Twitter. It's about settlement infrastructure. Using Ripple's RLUSD stablecoin on the XRP ledger for real-world transaction settlement expands XRP's role as liquidity plumbing behind the scenes. That's where long-term demand is born, not in hype cycles, but in repeatable usage. This is also where people misunderstand stablecoins and assume they compete with XRP. They don't. Stablecoins like RLUSD sit on top of the XRP ledger. They require liquidity bridges. They require neutral settlement assets to move value efficiently between systems, currencies, and jurisdictions. XRP's role is not replaced by stablecoins, it's reinforced by them. The more stablecoin activity that runs through the ledger, the more important the underlying liquidity layer becomes. Then you have the accumulation story, which is even more telling. Ripple-backed entities like Evernorth accumulating hundreds of millions of XRP through open market activity is not accidental. Large players don't accumulate assets they think are irrelevant. They accumulate assets they believe will be strategically important when liquidity infrastructure and regulation converge. Accumulation at that scale changes future supply dynamics, especially when it's tied to long-term corporate and institutional plans rather than short-term trading. This is where supply shocks don't look like sudden explosions. They look like absence. Over time, more XRP sits in strong hands, corporate treasuries, institutional vehicles, and long-term infrastructure uses. Less XRP circulates freely on exchanges. That doesn't guarantee price appreciation tomorrow, but it changes the elasticity of supply when demand eventually increases. Markets move fastest when demand rises and available supply quietly shrinks. Ripple's acquisition of G Treasury adds another layer to this picture. That deal wasn't about headlines. It was about integrating crypto assets into corporate treasury management. This is where the TradFi and DeFi worlds actually merge, not in slogans, but in operational workflows. If Ripple is positioning itself to serve enterprise treasury functions, XRP naturally becomes part of that liquidity and settlement stack. That's not speculation. That's business logic. All of this points to a shift in who XRP is being built for. The target audience is no longer retail traders chasing volatility. It's institutions that care about reliability, compliance, and scale. That doesn't mean price stops moving. It means price eventually reflects usage patterns rather than pure speculation. This is also why XRP often looks boring compared to newer narratives. Infrastructure doesn't excite people until it's everywhere. No one got excited about payment rails or settlement systems until they powered the global economy. And by the time everyone recognizes their importance, the opportunity is usually no longer obvious. The key takeaway here is that adoption doesn't always scream. Sometimes it whispers. And when you see real partnerships, real accumulation, and real supply positioning happening simultaneously, it's worth paying attention, especially when most of the market is distracted by short-term price action. Now let's zoom out, because none of these developments exist in a vacuum. Adoption, accumulation, and infrastructure only really matter when they line up with the broader macro environment, and heading into 2026, that environment is changing in ways that strongly favor assets built for settlement, liquidity, and compliance rather than speculation. We're moving into a phase where global finance is being forced to modernize its plumbing. Banks, payment networks, clearinghouses, and custodians are under pressure to reduce friction, increase transparency, and operate across borders more efficiently. This isn't a crypto narrative, it's a financial system problem. Legacy rails are slow, expensive, and fragmented, and institutions know it. That's why you're seeing increasing openness to blockchain-based settlement, tokenized assets, and on-chain infrastructure. This is where XRP's positioning becomes relevant at a macro level. XRP was not designed to be a store of value or a meme-driven speculative asset. It was designed to move value between systems that don't naturally talk to each other. In an environment where capital flows are becoming more complex, more regulated, and more global, that function matters, especially when institutions are no longer willing to tolerate opaque intermediaries or settlement delays that tie up capital. The rebranding of Hidden Road into Ripple Prime and its access to DTCC netting services is a strong signal of where this is heading. DTCC is not an experimental sandbox. It's core financial infrastructure. Gaining access there means Ripple is embedding itself deeper into the institutional stack. And when infrastructure integrates, it tends to persist. These are not short-term experiments. They're long-term commitments. On top of that, the expansion of RLUSD across multiple chains and environments adds another layer of relevance. Multi-chain liquidity doesn't reduce the need for a neutral bridge. It increases it. The more fragmented the ecosystem becomes, the more valuable a reliable settlement layer is. Stablecoins move value within systems. Bridge assets move value between systems. That distinction is critical, and it's one that many critics of XRP consistently ignore. There's also a geopolitical dimension that can't be ignored heading into the second half of this decade. De-dollarization narratives, regional payment corridors, and alternative settlement frameworks are no longer fringe discussions. They're being actively explored by governments and financial institutions. That doesn't mean the dollar disappears. It means the system becomes more complex, more multipolar, and more reliant on neutral settlement mechanisms. XRP fits naturally into that gap. This is also where timing matters. 2026 is not about instant gratification. It's far enough out that infrastructure decisions made today can start producing measurable impact. ETF accessibility, enterprise adoption, treasury integration, and cross-border settlement don't flip a switch overnight. They compound. and compounding infrastructure tends to create asymmetrical outcomes over longer time horizons. None of this guarantees XRP outperforms everything else. Markets are competitive. Technology evolves. Execution matters. But what it does suggest is that XRP is positioned in a part of the market that is likely to matter more, not less, as financial systems modernize. That's a very different thesis than chasing whatever narrative is hot in a given month. The real question heading into 2026 isn't whether XRP will pump next. It's whether assets built for real-world financial integration will finally start being valued for that role. And if that shift happens, the assets that spent years building quietly tend to benefit the most. So when you pull all of this together, the question isn't whether XRP is a guaranteed winner or whether it's going to hit some absurd price target by a certain date. That's the wrong way to think about it. The real question heading into 2026 is whether XRP has moved into a category that most crypto assets never reach, one where it's evaluated less as a speculative trade and more as financial infrastructure with a defined role. XRP today is not the same asset it was 5 years ago in terms of risk profile. Regulatory uncertainty has been resolved. Institutional access has expanded through ETFs and custodians. Real-world payment and settlement integrations are no longer theoretical. Supply dynamics are being influenced by long-term accumulation rather than pure retail speculation. And macro trends are pushing the financial system toward exactly the kind of efficiency and interoperability XRP was designed for. That doesn't guarantee upside, but it does change the probability landscape. At the same time, it's important to stay grounded. XRP still operates inside volatile markets. It is still correlated to broader crypto and risk assets. Competition exists, execution matters, and adoption timelines can be slower than expected. Anyone telling you XRP is inevitable or that it's going to some predetermined number is selling certainty that doesn't exist. Markets don't reward blind conviction. They reward informed patience. What makes XRP interesting as a potential 2026 investment idea is not hype, but alignment. Alignment between regulation, infrastructure, institutional behavior, and macro direction. When those forces line up, assets don't usually move in straight lines. They move in phases, long periods of frustration followed by repricing once the market recognizes what's actually been built underneath the surface. That's why dismissing XRP outright at this stage is just as lazy as blindly shilling it. Serious investors don't deal in absolutes. They weigh evidence, assess risk, and decide whether an asset fits their time horizon and strategy. XRP may not be right for everyone, but pretending there's nothing there ignores a growing list of concrete developments that didn't exist in prior cycles. If you're looking toward 2026, the mindset has to shift from chasing noise to understanding structure, from asking what will pump next to asking what still matters when the cycle turns. Assets that survive regulatory scrutiny, integrate with legacy finance, and solve real problems tend to stay relevant longer than most people expect. And before we wrap this up, it's important to be clear and responsible. Everything discussed in this video is for educational and informational purposes only. This is not financial advice. I'm not telling you to buy, sell, or hold XRP or any other asset. You are responsible for your own research, your own risk management, and your own investment decisions. Markets involve risk, and nothing in crypto is guaranteed. Always do your own research and only invest what you can afford to lose. If you approach XRP or any investment with that mindset, you put yourself in a far better position than most people in this space. Not because you're chasing certainty, but because you're respecting reality. And in the long run, that's what actually compounds.